Tuesday, December 1st, 2020, Maneco 64, home of alternative economics and contrarian views. I always like to thank my supporters, viewers, at this time of the month for the previous month's support, not only because of their interest in the channel, but also their support through Patreon, PayPal, through using the Teespring store. Yes, I appreciate it. Yesterday was an interesting day for the channel. We gained more than 300 subscribers, which is rare for my channel. And even though I have videos that have over 200,000 or 100,000 views, yesterday's video was quite amazing. I've never seen a video of mine, at least, get as many views as it did in the first 24 hours. We're almost up to 30,000. So thank you for all the new viewers and new subscribers as well. So today we're going to look at how governments, by interfering in markets, usually have the opposite effect of what they're trying to do. I've been a proponent of free markets, of laissez-faire, small government, because I think the free market and the price signal in a free market really determines what should be done. It's not a few men or women in an office or in a boardroom that decide what's best for the market. And today we're going to see how the UK government has built a short-term housing bubble in the UK. And there's some news this morning about house prices in the UK. And you'll probably be surprised at what they did. But before we do that, let's look at where the markets are. It's 8:43 a.m. London. So we'll start with precious metals, gold and silver, of course. We've got spot gold at $17.92. So we're up $15 or just under 1%. The range has been 1771 to 1795. Yesterday, I think the low was around 1765. So gold is rebounding quite well here in the beginning of the month, December 1st. Silver did very well yesterday. It got hit really hard. I think it went down to like 21.88, but actually finished the day unchanged or even slightly higher. And today, silver is up 2% at 23.06, up 45 cents. The high's been 23.13 and the low 22.57. We noticed yesterday, of course, the dollar index made a low for the year. I think the low was around 91.50, and then it rebounded. This morning, dollar index is back down. It's down about 0.25% at 91.67. So the dollar's still under pressure. So let's look at high-grade copper before we look at the stock market, because yesterday I noticed that copper, which has been really rebounding since the low back in March when we had the crash in everything, of course. It's rebounded from below $2 and we're now at 3.48. And if you look at copper here on this chart, we are at a almost 7-year or almost even 8-year high. So and that was happening yesterday as well. Copper was doing really well. And if you look at the other base metals like aluminium or aluminum, as the Americans would say, we're making like a recent high as well. It's really moving higher. Zinc, the same thing, as you can see here, even iron ore. So all these industrial and base metals are telling us that either the economies are going to pick up really well, or we're going to see the dollar weaken. And we are seeing, of course, the dollar weaken through the dollar index. So why would commodities go up if the dollar weakens? Well, because the dollar is the major reserve currency of the world, and everyone has to buy commodities in dollars. So when commodities are going up, it means that the dollar is going down. So I think that's what's going on. And that's why I'm not shocked to see gold and silver rise here because it doesn't make sense for them to stay down that long, I would say. So there we go. Let's see where the stock markets are. We saw the stock market under pressure yesterday. Most of the day, they did rally quite a bit towards the end of the day. But be as it may, this morning they're up again. The Dow is just below 30,000. The high has been 29,988. That's the future. We're up 300 points right now, so just over 1%. S&P is up 1% at 3658. NASDAQ 100 future is up 0.75%. So yeah, I think the weakness in the dollar is pushing everything up. Is it a sign that we're going to have a V-shaped recovery? I'm not too sure about that. I think there's still a lot of uncertainty, even politically. A lot of people are assuming that Biden is going to be the president. I'm not too sure about that. There's a lot going on behind the scenes in states like Arizona, Georgia, Pennsylvania, as it pertains to the vote count. And I know the mainstream media is not covering it because they don't want people to know about that. And am I taking sides? No, I'm just an observer from outside, but I think people need to keep in mind the risk, political risk still. I don't think it's over yet. It's far from over. And we've got people talking as if Janet Yellen, for example, is going to be the new U.S. Treasury Secretary. Well, hold your horses. Let's wait till December 14th, see what happens until then. Anyway, as I said, the dollar is a lot weaker this morning. We're seeing the pound rise up above 134. It's up 0.59%. We've got the euro just below 120. It's up 0.5% at 119.81. And the dollar's actually hasn't really moved that much versus the yen. It's pretty much unchanged, 104.22. The dollar is down 0.33% versus the Chinese yuan at 6.56. And what about crude oil? Well, crude oil is up 0.5%, WTI at 45.65. So yeah, commodities picking up again. I listened to an interview by Grant Williams with Stansberry Research yesterday. He said that he also favors commodities because he said that the relationship between commodity prices and the general stock market hasn't been as low as it is, or the ratio, in about 500 years. I thought it was more like 120 years, but yeah, so in recorded, let's say modern recorded history, commodities are still, he favors the mining stocks as well, as I do. Yes, I noticed yesterday my mining shares did pick up compared to Friday, the Friday before. And even on Friday, the mining stocks didn't do much. They held pretty well. So I think they were kind of forecasting a bottom for metals. We'll have to see. Of course, markets are very difficult to know what they're doing in the short term. To finish off the markets, the 10-year yield is still at 0.84, just where it was yesterday when I made my video. So now to the UK house prices. Yes, governments think they're clever, politicians, but whatever they do to try to solve a market problem, they have the opposite effect. When they put price controls like Nixon did in the early 70s, actually prices went up. I think rental controls, people couldn't rent properties. And why is that? Or you try to put put price controls on agricultural goods like the French did in the 1790s during the fiat money inflation there. What happens? Well, the farmers, they know that they're not going to make a return on their crops if they sell it at the government price. So they stop growing and selling their crops because they're not there to lose money, or else they'll go out of business. So yeah, governments think they're clever, and they always do the wrong thing. And right after the crisis hit here and the lockdown, they decided to suspend the stamp duty, which is a tax when you buy a property. The buyer pays the stamp duty, and they decided to revoke that stamp duty for houses up to £500,000 up until March, the end of March next year. And you might say, well, you don't like taxes. Well, I don't, but this is different because they're going to bring it back, right, in March, at the end of March next year. So it doesn't mean that they're like scrapping the tax. They're just revoking it temporarily. And what that's done is encourage people to buy properties. And this is what you get. So the headline this morning, about an hour ago or so, we had news of UK house prices. It says UK house prices rise at fastest rate in 6 years. So does it make sense? While the country is in lockdown, we've had a big retail company, Arcadia, go into administration yesterday with the possibility of 13,000 people losing their jobs. We don't know where we are, if we're going to be in some kind of lockdown till March. I'm hearing June next year, and we've got people rushing to buy houses and driving up prices, taking on more debt. I think it's dangerous. So let's see what the FT has to say. UK house prices rose more than expected last month, and at the fastest annual rate in 6 years, as buyers rush to benefit from a property tax reprieve in place until March. The average price defied expectations to gain 0.8% to 230,000 in November compared with the previous month, the fifth consecutive expansion nationwide, said on Tuesday. The other thing as well I've read recently is that mortgage companies or mortgage providers are raising interest rates on such properties because there's such a high demand that they're concerned. So they're raising interest rates while you have the central bank, of course, cutting rates. These figures feel like the storm before the calm, as buyers and sellers rush to take advantage of the stamp duty holiday before the March deadline. Despite continued COVID restrictions in October, the possibility of a no-deal Brexit and economic growth stalling, said Jeremy Leaf, North London estate agent and a former RICS residential chairman. That's the Royal Institute for Chartered Surveyors, I think. RICS, R-I-C-S. So here's the rise in house prices, highest in 6 years. So house prices rose 6.5% in November from the same month a year ago, the fastest pace since January 2015, and swifter than a Reuters poll of 5.5%. The October annual growth rate was 5.8%. The housing market has experienced a mini boom since the summer when the stamp duty holiday was introduced in July. The sector was expected to cool down in the autumn as the economy weakened and job losses mounted. Mortgage approvals rose to the highest level since September 07 in October, the Bank of England said on Monday. The nation is engaged in a mass rethink over where to live following 2 lockdowns, all while interest rates are ultra low, said Simon Gammon, managing partner of Knight Frank Finance. That's fueling gains in house prices, and activity has been particularly strong in countryside markets as buyers seek better access to green space. That was this guy, Simon Gammon, who said that. So what do I think about all this? Do I think we should move to the countryside if you can from the big cities? I think so eventually, but I think it's too early to decide. we've noted now with this coming tier system from tomorrow that people in the countryside in Kent are going to be under tier 3. So they won't be able to come and visit maybe relatives that they have in London, which is under tier 2. I think it's still early days. And I think this rush like this is never good. Hasty action is never good. I might be wrong. The other interesting thing, though, my wife went out, I think yesterday or Sunday. She went up to buy something. She walked up to a shop nearby, and she saw one of her friends who lives on the same road. And she said that she's just sold her house. And apparently she put the house up, and the same day she got an offer for it. So that's not surprising, seeing that this is going on. So there you go. Yeah, beware of these government programs. Whenever governments try to solve a problem, they make things worse. But unfortunately, as I've said many times, we're living in a Keynesian paradigm where everyone thinks that the government, the central bank, and other institutions have to interfere. They don't trust the free market. They don't trust people to do the right thing. And they push people to do the wrong things usually. And I think this is what's happening here personally, but we'll have to wait and see in the longer term what happens. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Parler, and all these other platforms below here. I wish you all a great day. Take care. Bye.